I'm not too sure if you've gotten the memo, but the US stock market has been on fire lately. Major US indices, the Dow, the S&P, and the Nasdaq just recorded a new all-time high after Donald Trump was announced as the new president. So this comes on the back of a recent forecast from Goldman Sachs, telegraphing, and I quote, just 3% over the next decade, after S&P's historic run, clocking in an average of 13% per annum over the last 10 years, unquote. So in this video, we'll be exploring the claims made by Goldman Sachs, supplement the analysis with views from other analysts on Wall Street, and ultimately come out with our own conclusion. So we've done lots of research and digging, so if you don't mind taking a dig at the like button as well, it will help with my KPI. Now, let's first look at what Goldman Sachs put out. So in essence, their claim is summarized in this one chart here. They've tabulated the distribution of the S&P 500 annualized 10-year return since all the way back to 1930. And the baseline forecast is that for the upcoming decade, from the period 2024, which is today, to 2034, it's between -1% to 7%. Yes, you've heard it right. In their worst case scenario, they're kind of hinting at a lost decade for the S&P 500, with a -1% CAGR for the upcoming 10 years. In this all-time high market, you might be confused as to where to put your money. So you can now register for our upcoming live black market online event where Adam Khoo will be sharing with you timeless investing principles. In particular, how he picks undervalued gems that carries lucrative long-term potential, even in this all-time high market. Tickets are free and spots are limited, so head down to the link below to grab your spot now. As a registration bonus, you'll also receive Adam's November stock market secrets report containing his latest market analysis. So I'll see you at the event. Now, back to the video. So at first glance, some investors might be thinking, what is Goldman Sachs smoking? I might want some of it too. But the math underpinning this is rather simple. So the average return of the S&P over the last 100 years is roughly 10 to 11%. So we've got a range of returns around this midpoint, and they would ultimately converge to give you this long-term average return. So more often than not, as seen from this distribution here, they wouldn't exactly give you 11%, but it's just an average of all the scenarios combined. So I've then taken the liberty to actually calculate what the returns were in the previous decade, from 2004 to 2013. Want to take a guess? What's the figure? It's actually 7.4% per annum. Not surprising, right? From a decade of low returns, I'm transitioning next to a period of higher performance, which we have seen over the last decade or so. And right now, at this current juncture, are we primed for the next low cycle? So I think before we jump the gun, I think it's important to ground ourselves in facts and probability rather than jumping to simple conclusions. So for one, a research done by Ritholtz Wealth Management showed that it is actually very rare to see such low returns over a 10-year stretch, but it can still happen. So roughly 9% of all rolling 10-year annual returns since 1926 have been 3% or lesser. They've also noted that in those periods of below average returns, they all occurred in or around some of the worst economic times of the past 100 years. The Great Depression in the 1930s, the stagflation in the 1970s, and the Great Financial Crisis in 2008. So in other words, if you do buy into this base case assumption put forth by Goldman Sachs, by translation, you're expecting a large crisis to hit us exactly in the coming decade. It's improbable, but still possible. And on that note, in a recent Bloomberg report, David Kelly from JP Morgan Asset Management actually pushed back on the Goldman forecast, stating that, and I quote, "I feel more confident in our numbers than theirs over the next decade." So JP Morgan expects large cap US stocks to return an annualized 6.7% over the next 10 to 15 years, and think that American corporations are extreme. They've got sharp elbows and they're very good at growing margins, unquote. Now, I think that there's a lot of guessing and reading in between the lines through these two sentences, so I hope to provide more color. So I think that we need to first have a high-level overview of the market from JP Morgan's point of view. So in the recent guide to the markets from JPM, I think 3 charts help to set the context and understanding. First, what we are looking at here is the S&P 500 index at inflection points. So JP Morgan has kindly outlined the key characteristics and specific periods for comparison. So we're looking across 5 different occasions: the dot-com in 2000, the Great Financial Crisis in 2007, the pandemic in 2020, the inflation/recession scare in 2022, and compared to today. So when benchmarked against, for example, the forward PE ratio and a 10-year treasury, we can agree that the index is on the high side, but not necessarily comparable to bubble territory of the dot-com yet. So the second chart we are looking at is the distribution of the S&P forward PE ratio. As at end October 2024, the forward PE is slightly above 21 times, and it's one standard deviation above the 30-year average. So are we on the high side? No doubt. But the more important question is, would the index come down significantly enough so that you can buy it on the cheaper front? The answer is probably, but who knows? Heck, if the fundamentals of the companies continue to improve and deliver, the index can continue to stay quote-unquote expensive a lot longer, because earnings improve and the PE as a function comes down automatically as the denominator becomes a lot larger down the line. And here's the third chart that we're looking at. It's the relationship between PE ratios and equity returns. So at current levels, it is more probable than not that the subsequent 1 to 5 year annualized returns will be on the lower side, because higher expectations are being priced into valuations today. Of course, there would always be outliers, but the general trend stands. When the lower the valuation, the lesser the expectations are priced in, the higher the potential subsequent returns, vice versa. Now, it seems as if JP Morgan is also not painting a pretty picture about the future returns of the S&P 500. Maybe not as pessimistic as compared to Goldman, but still a much more muted returns going into the decade. So I then cross-checked this view with a report from Morgan Stanley, updated as of November 4th. So under the section 6 charts you can't miss, the 10-year nominal expected returns for US stocks sits right around 7.8%. Still much lower than the 10 to 12% many investors are probably expecting, considering the previous decade of the bull run that we've experienced. So the US equity risk premium is also close at its all-time lows versus its history, currently sitting at roughly 2.7%. So for those of you not very familiar with the term equity risk premium, it's basically the extra returns that investors expect to earn from stocks over risk-free investments like government bonds, for example. So long story short, it's a compensation to investors that are willing to take higher risks. So when the risk premium is at historical lows, it could mean one of two things. So there's lower expected returns for stocks due to less potential upside in stocks relative to bonds, or it could mean that stocks are very popular and their valuations are on the higher side and investors are willing to accept a smaller premium because they feel safer about stocks. So considering the 3 perspectives from some of the top banks in the world today, Goldman, JPM, and Morgan Stanley, they all seem to be singing the same tune, just to varying degrees. So markets seem to be pricing in quite a bit of expectations. Generally, we look expensive, arguably not in bubble territory yet. Expected returns might look more muted in the coming decade if you're to buy at today's valuations, and we can't know for sure. So I know the research put forward by them might seem like they're all on the bearish side, but I'd just like to remind everyone that predicting future returns is hard. Goldman Sachs, JP Morgan, or insert whichever bank name here, they don't know the future any better than you or I do. So we are all trying to make sense of the data that we have on hand and projecting out into the future. Across decades, we have seen many of these elites making awfully wrong predictions that have cost investors a fortune if they found themselves trapped in this ongoing prophecy that the stock market will crash. So markets do move in cycles and we will inevitably experience another bear market or a significant drawdown. So the key here isn't in trying to time the next bear market, but more importantly, know which company to buy and when to buy them. So here's our bottom line. It's no doubt that markets do look on the more expensive side today, but we often forget that the S&P is not driven by just price or valuations alone. So the underlying company's performance, how much earnings they deliver, is arguably even more important for the long term. So as the famous Buffett quoting Ben Graham, in the short run, the stock market is a voting machine, whereas in the long run, it is a weighing machine. So in order for the market index to march higher, the companies in the index must be able to deliver greater profitability and earnings. So going back to the JPM forecast, we are looking at continued strong earnings growth out into 2026, with the Magnificent Seven leading the pack, which probably suggests why investors are willing to pay a much higher premium for the Magnificent Seven names compared to the rest of the 493. And as Yardeni puts across his point, and I quote, "A looming lost decade for US stocks is unlikely if earnings and dividends continue to grow at solid paces, boosted by higher profit margins, thanks to better technology-led productivity growth." So if the productivity growth boom continues through the end of the decade into the 2030s, we expect the S&P 500 average annual return. It should at least match the 6 to 7% achieved since the early 1990s, and it should be more like 11%, including reinvested dividends, unquote. So for now, considering the innovation wave led by AI and tech, we don't have reasons to assume otherwise, that this trend towards higher productivity, higher margins, and higher profitability will change anytime soon, barring any black swan or unforeseen developments. And black swan events, by nature, is unpredictable, and we can only prepare ourselves by making sure that our portfolio consists of high-quality companies that are able to withstand any storm. So rather than spending time thinking about when and what would be the next black swan, our time would be better spent on analysing quality companies and figuring out a fair valuation to pay for them. So at Piranha Profits, we believe that the bull market still has a strong runway ahead, propelled by unprecedented productivity gains via innovations, the current upcycle of the global liquidity trend, and the secular and cyclical bull market patterns we are currently in. That said, we would caution against chasing the rally blindly and be prudent in adding during pullbacks and make sure to only buy stocks that are undervalued. So at our upcoming live black market event, Adam Khoo will be sharing his secrets as to how he beat the market over the last 5 years and which frontrunner stocks he's watching that are poised to lead the current rally. So tickets to black market are free and getting snapped up fast. So go to the link below to grab yours now. So this is CK from Piranha Profit signing off. Till next time, keep winning.